Inflation seems to be the talk of the town, but what exactly is it? How does inflation affect your investments, and more importantly, are there ways to minimize its impact, if not capitalize on it and use it to your advantage? Put simply, inflation is too much money chasing too few goods. It represents an increase in the price of goods and services and a decrease in the purchasing power of a currency. It's important to investors since inflation can impact almost every aspect of our markets and in turn, your portfolio. There has been a huge influx of capital into the U.S. economy over the past 18 months, to the tune of around $15 trillion, in large part due to the U.S. government's COVID-19 economic stimulus and relief measures. That's a staggering amount of money, especially when you compare it to the comparatively trifling $2.5 trillion added to the economy in the previous 70 years. Now, the Federal Reserve likes to keep inflation around 2 to 2.5% per year. If prices continue to spiral upward and the inflation rate reaches 5% or above, the Fed often steps in and acts. It can slow down the purchase of mortgage-backed securities and treasuries, which might cause interest rates to rise. If interest rates rise and your portfolio is already full of bonds, you're likely to see their value decrease, since newer bonds will be issued at a higher rate to attract investors. The classic hedge against inflation has always been to buy gold, since a weakened dollar tends to increase the value of gold. But that inverse correlation doesn't hold true 100% of the time, and hasn't been as tight as it used to be. But are there other ways to hedge, if not seize opportunities during periods of higher inflation to both protect and grow your investments? For the educated investor, there can be some ways if you have the skills. You can short the equity markets with a broad market ETF, invest in inflation-resistant digital assets like Bitcoin, short the US dollar in the Forex market, or you can use options to hedge your current long positions. Treasury inflation-protected securities, or TIPS, also offer a degree of protection against inflation. The principle of TIPS adjusts to changes in the consumer price index, increasing with inflation and decreasing as it falls. TIPS have been laying low, along with inflation, for years, as there hasn't been much interest in them from the retail investors. Big banks and institutions don't lose too much sleep over inflation and market corrections. They have plans and strategies to protect and grow their investments when the market goes up, down, or sideways. Inflation may affect your pocketbook, but an educated investor knows there are ways to protect their portfolio and potentially to even profit from it.